What is tax loss harvesting, and is now a good time to do it? Well, here to talk with us about that is Amy Shepard from Sensible Money. Amy, welcome.
Hi, Bob. Thanks for having me.
Pleasure. So the stock market is very volatile, and people are talking about something called tax loss harvesting. What is it?
Yes, I have been talking about it a lot with my clients. I think a normal reaction to stock market volatility is people get nervous. You see your account values falling and it doesn't feel good. As financial planners and as just an optimist, naturally, I always try to find the silver lining. And so the silver lining with stock market volatility is an opportunity for something called tax loss harvesting. It really has two components. So the first component is that you sell an investment that's down in value. You realize a loss for tax purposes. And then the second piece is you typically take the proceeds from whatever you sold and reinvest that money. And so we'll walk through the details. Before I go through the specifics, one thing I will say is that a really important key with tax loss harvesting is it can only be done in taxable brokerage accounts. You can essentially do it in a retirement account, but you don't get any tax benefits. So you could sell something for a loss and buy something else. It just doesn't do anything for your tax situation.
Right. So step one is realizing the loss for tax purposes. Walk us through that.
Yep. So step one is you look at that falling account value of yours and you figure out, okay, where's the opportunity here? An example that I use because it's been coming up really frequently right now with my own clients is a lot of my clients have emerging markets funds, mutual funds or ETFs that are down in value. And so the example I put in the article is that say you bought an emerging markets fund through DFA, that's a mutual fund company. You bought it for $100,000. It's currently worth $80,000. That means, on paper, it's down $20,000 since what you bought it for. So what you could do is you could sell it right now for $80,000, and then that $20,000 loss essentially gets realized for tax purposes. And there's two ways that that $20,000 loss can benefit you for tax purposes. The first way is you can use what's called a capital loss. So you could use that capital loss to offset capital gains. There's, of course, like many things, a lot of nuances there. Um, Say you were fortunate enough to sell some investments maybe earlier this year before the market started getting a little crazy, and now you realized this $20,000 loss. That $20,000 loss could be used to offset capital gains you realized earlier in the year. That's one option. You could also, maybe the market bounces back quite a bit between now and the end of the year, and you realize a capital gain, before the end of the year. That capital loss that you realize right now can be used to offset that future capital gain. Um, what if you don't have any capital gains this year? That's okay too. The capital loss, that $20,000 loss that we're using as an example, it can carry forward. One of the benefits if you don't have any losses, or I'm sorry, if you don't have any gains to offset it with, is you can actually use $3,000 per year of a capital loss to offset ordinary income. I have an example that I put in the article as well. But say you made $100,000 of income this year, no capital gains to use that loss against. What you could do is you could use 3,000 of that loss to reduce your income from say 100,000 to 97,000. That means you're using 3,000 of the $20,000 loss, and then the remaining $17,000 could carry forward in future years. So that was a mouthful. There's a lot of numbers. Hopefully, the article helps walk through an example, and I know a lot of people like to kind of see the numbers with their own eyes to help walk through it. But those are really the two ways to use it: is to offset capital gains or offset ordinary income, and it can be carried forward. So it's not a use it or lose it type deal.
So that's step one. Step two is reinvesting these sale proceeds.
Yes. So reinvesting the sale proceeds is really important because, a lot of times when we're talking about investments, a lot of people know kind of a general rule is you don't want to sell things at a loss, right? That's kind of like investing 101 is the goal is to make money over the long term. With tax loss harvesting, it's the exception to that rule. It's an opportunity to sell something at a loss, but it has to still make sense for your long-term financial plan. And so typically what that means is if we use that same example, you bought a DFA, emerging market funds, that is down in value, you sold it. You realized that loss for tax purpose. In the example we used, we said you sold it for $80,000. Well, now what do you do with that $80,000? A really common thing that people do is they just take that $80,000 and they reinvest it into a similar fund. So if it was invested in a DFA emerging markets fund, now maybe what they'll do is they'll buy a Schwab emerging markets fund or a Vanguard emerging markets fund or something like that. The reason this is so important is because now that money is still invested. You still have the ability to participate in the eventual market recovery whenever that happens. Sometimes it happens quickly and sometimes it takes a really long time. But that's typically what most people do is they just swap, one fund family for another, but they keep the same asset allocation.
Mhm. So the other thing that you could do is not only a similar investment, but a different asset class as well.
Yes, so that is another option. So we do that often for clients if they come in with uh, assets that maybe don't align to their long-term financial plan. And so an example there is, maybe a client has a whole bunch of large US large cap stocks, but after we create their plan and we figure out their asset allocation, the recommendation is not to have quite as much in US large cap stocks. So in that example, maybe we would sell those at a loss. We realize the tax purpose, but then instead of reinvesting into a different US large cap fund, we might invest in a totally different asset class that is a better fit for their long term financial plan. So, those are the two, I think, most common ways people reinvest, either staying in the same category or moving to a different category that makes more sense for the long term. But
Right.
like anything, there are always it depends in different scenarios that might make sense for your specific situation.
Right. And if someone's contemplating tax loss harvesting, there's one more item they need to be aware of, which is something called the wash sale rule.
The wash sale rule is huge. So, and it sounds so straightforward when you read it, but there's some things that can really trip you up. So, um, the wash sale rule basically says in order to get the tax benefit of tax loss harvesting, you cannot if you sell something at a loss and you want to use that loss on your tax return, you cannot buy a substantially identical investment within 30 days before or after the sale. And so the before or after is really important. It's essentially like a 60-day period around the date of the sale where you want to make sure you're not negating that loss that you just realized. And so the way it can really trip people up is if you're still working and you have stock options like RSUs that are vesting, or you participate in employee stock purchase plans, or if you have, stock that or mutual funds that you have automatic reinvestments on, sometimes that can trigger the wash sale rule unintentionally. So you may sell something at a loss and you have no intention to buy that same investment, within 30 days. But you forgot that, dividends are coming due and they're going to be reinvested, and that dividend reinvestment essentially causes you to buy more shares, which complicates the wash sale rule, and it causes you to not be able to use that loss that you thought you were being strategic for. So that is wash sale rule in a nutshell, but it is a tricky thing.
Right. So we covered a lot of ground. Anything we missed or anything that bears reemphasizing?
I think my kind of keynote finish here is just that when you do see your taxable brokerage accounts down in value, it's normal to be nervous. You don't ever want to see your hard earned money going the wrong direction. But just remember that when there are bumps in the stock market, there can be opportunities. And so tax loss harvesting can be one of those opportunities.
All right, Amy, always a pleasure having you share your knowledge and wisdom with our readers and viewers. It's greatly appreciated.
Thanks so much, Bob.